Caleb, you can go ahead.
Okay, so I was saying that, for instance, you buy an item on credit. So let's say you buy some goods from the US, but as at the time of the transaction, as at the time you're paying, buying the goods, the exchange was $1 to, let's say, 5.78 Ghana cedis. However, at the time of payment for the goods, the exchange, the risk that the exchange rate might either increase or change is the transaction risk.
Okay, fantastic. That's a very good example. That's a very, very good example. So you see, if you look at all these risks, they are all tied in, they look very, very alike. That's why I'm taking my time to go through them. So thank you, Caleb. That's a very, very good example. Very, very good example. Okay, so transaction risk is the forex risk. It's what we call the forex risk that arises in transactions between two parties. So this was what Caleb was describing to us. You have one person in the US, one person in Ghana. So two parties where the normal transaction currency of each party is different. Right? So you buy something on credit at maybe 1st September. 1st September, you buying something on credit 1st September, it was 1-to-1. Then 1st December, it changes totally. There's a transaction risk in that case. So the transaction risk is the risk that for any future transaction in a foreign currency, the amount received or paid in domestic currency might be different. Might be different. So that's the key here. Might be different from the amount originally expected. I hope that makes sense. So I give a typical example here. Transaction risk will arise when a UK company buys goods from a Chinese supplier when the price is in, let's say, US dollars or UK pounds, or whatever it is. And payment is required 3 months after the date of purchase. Yeah. So what you expect it to be and what it actually turns out to be, it's very, very different. It's quite weird. Okay, so it's because of these plenty risks, that the whole concept of hedging comes in, right? Because of these risks, we have to hedge. And if you don't remember anything about hedging, remember that hedging is a risk management technique. Hedging is a risk management technique. Hedging is a risk management technique. So the purpose of hedging and exposure to risk is to eliminate or reduce the possibility that actual events will turn out worse than expected. The purpose of hedging and exposure to currency risk is to remove the possibility that a future transaction involving a foreign currency will have to be made at a less favorable exchange rate than expected. So that's the whole purpose of risk, right? You are trying to eliminate or reduce the risk. And so how do these hedges happen? Right? How do these hedges? There are several ways that companies can decide to hedge, So they might hedge by fixing an exchange rate now. So if they are supposed to make a payment they enter into a contract with someone, they're supposed to make a payment in 3 months' time. You can fix the exchange rate now and say, you know what? I'm a Ghanaian businessman. I'm buying goods from China. Today, the Ghana cedis to the Chinese yuan or whatever it is 1:1. I'm supposed to pay you in 3 months' time after I've sold the products. But you know what? We are going to use today's dates, not the 3 months' time dates. So that is fixing the exchange rate now for a future transaction. You can hedge that way. So the most important methods of hedging exposures to currency risk, which will be expected to know for the examination, are matching receipts and payments, netting receipts and expenditure, forward exchange rates, creating a money market hedge, currency futures, currency options, and currency swaps. So we'll be talking about these one by one because I think they are important when it comes to. Please, this is not true and poor, right? We are talking about these are strategies. So let's say you go into a case or a pre-scene or your exam and you see that, oh, there's a treasury management problem, right? Somebody is getting goods from maybe the US, These are strategies you could recommend, right? Okay, enter into a fixed, exchange rate system, These are things you can recommend. So it's not like chewing and pouring. It's more of understanding exactly what's happening here. Okay. So what is matching receipts and payment? This involves basically matching foreign currency receipts and payments in order to reduce transaction risk. So what do we mean? Let me read what I have on the slide first so that before I give you my explanation. When a company expects to have future cash receipts in a foreign currency and future cash payments in the same currency at about the same time, it can use the receipt to make some or all of the payments, right? So let's say if you take a Chinese company, right? I don't know why I'm using Chinese companies today like that. If you take a Chinese company, right, the Chinese company, okay, let's use a Ghanaian company. Let's use a Ghanaian company. So if you take a Ghanaian company, in relation to matching receipts and payment, this is how it's going to work like. A Ghanaian company is having business with a Chinese company, and so they'll have to pay the Chinese company in yuan, right? But let's say, for some reason, another Chinese company in China also does some business with this Ghanaian company. So let's say this Ghanaian company is into selling, herbal products or whatever it is, to reduce transaction risk, the Ghanaian company will take the foreign currency payments, which is in Chinese yuan, and match them against the foreign currency receipts, which is also in Chinese yuan, to reduce any form of transaction risk. I hope that makes sense. Does it make sense? Does it make sense or it doesn't? It's pretty straightforward.
Yes, please.
Yeah. Then you also have what we call netting. Netting is similar concepts, similar concepts. It's like so similar concepts, netting. Netting can be applied to cash flows in a foreign currency or to assets and liabilities denominated in a foreign currency. It is a process which involves netting credit balances against debit balances. So you owe someone and someone owes you, right? You net it. so that you only have to pay the outstanding. And what do you do when you do that? You save transaction costs, because anytime you are making, sometimes you are making these foreign currency payments, you have to wire money, and that comes with some transaction costs, So maybe this person, you owe somebody $2,000, the other person owes you $1,005. You net it, and what you actually have left is $500, and that reduces and that saves you a lot of transaction costs. So that's the concept of netting. Then you have interest rate swaps. Interest rate swaps. Can anyone attempt to explain this thing? Swaps. I'm not doing the CFA here, so I'll not make it complicated. Interest rate swaps. Can anyone attempt this? Anytime I talk about this, everyone goes quiet.
Long-term interest rates.
Sorry? Hey, I couldn't hear. Okay, so I'll read what's on the slide and I'll explain in simple terms. And I'm sure when I explain, you definitely get it. It can be confused, but it shouldn't be confusing for you at all. So an interest rate swap is an agreement between two parties, such as a company and a bank, where these parties agree to exchange interest payments at an agreed date. Okay, so Melody says, the slide says swaps are long-term agreements on interest rates. Yeah, that's what the slides are saying. So, but I just want you to understand, when you say you are swapping something with someone, what does it mean? You are exchanging something with someone, right? Let's swap books or let's swap pens, right? So it means that I'm swapping my pen with another person. So interest rate swap, you are swapping interest rates with another. So you are exchanging interest rate payments on some amounts of principal at an agreed rate throughout the term of the agreement. But why would anyone do that? That's the more important thing. Why would anyone sit there and be swapping interest rates? Okay, so what you need to understand is that it is this swap is very, very useful when you need to understand that interest rates are fundamentally two types. You have the variable interest rates and you have the fixed interest rates, right? You need to understand that sometimes companies want to go for a variable interest rate to be able to take advantage of the fluctuations in that interest rate, right? Because as the interest rate fluctuates, it benefits them. So that's one side. So a company might want to receive variable interest rates, receive payments with a variable interest rate, while the other party might also want to, limit their risk by receiving a fixed rate, So it's like a win-win for people. So maybe on one side, one person wants a variable rate, another person wants a fixed rate. So they exchange based on that. So the purpose of an interest rate swap is often to swap a variable rate of interest payment into a fixed interest rate payment, and swap a fixed rate of interest payment into a variable rate of interest payment. I hope it's clear, because both fixed interests and variable interests, they have their own advantages depending on where you are sitting, right? So if I'm a borrower, right, I would love my interest rate to be fixed, especially in a country where, you know, things are fluctuating up and down. You know, if the rate is variable, it might go against me. So I might want a fixed interest rate. If I'm on the other side where I'm a lender, I might want a variable rate of interest in a place where, you know, things change very, very frequently, or there are fluctuations very, very frequently, right? And so I might want a variable rate of interest payment in that sense. So two people come together and make exchanges that makes sense, or that benefits them mutually. I hope that makes sense. I've tried to make it as simple as possible. Can get complicated. Does it make sense? Let me know. Okay, it looks like it makes sense. So I'll just move on. Then you have forward contracts.
Hello, sir.
Yes.
Hello, sir.
Yes.
Please, I have a question.
Okay.
Concerning the swaps, is it that there are two investors, let's say one who is investing in something different, and another person who is investing in something different, and then maybe because one person doesn't want or is risk averse, so he would go for someone else's fixed, and then the other person who wants to benefit from the variable come for his variable, or what? I want to be clear on that issue.
Yeah, so that's an example of why somebody will go into an interest rate swap, right? What you just said is an example of why somebody will go into an interest rate swap. People go into things for different reasons, right? So maybe someone is risk averse, and so they'll say that I might want a fixed, I might want to swap for a fixed interest rate. So depending on where you are sitting, whether you're a lender, whether you're a borrower, you know, depending on the side of the coin that you are in and your interest, what you want to achieve with the swap. Because sometimes you can go into a swap to make money. You know, you look at the trends. If you look and you check that, oh, if I do a variable interest rate, if I go for variable interest rates, the way the economy is going, the fluctuations happening in the economy, it might go in my favor. And so you might swap for that. And so you might give up your fixed interest rate payment to another person who is probably like a borrower, who might want, you know, safety and is averse to risk. So depending on where you're sitting on the side of the coin, then you make those decisions and your interests, you know, what you want to achieve with it. I hope it makes sense. So yes, what you give is a typical example. Did I answer your question? Hey. Did I answer your question? Did I answer his question? No.
Yes, please. Thank you, sir.
Okay, Francis. Okay, so let's move on to forward contracts. As the name suggests, a forward contract is a contract entered into now for settlement at an agreed future date. You know, so you enter into a contract now for settlement to be done at a future date. So you say, oh, Auntie, Auntie Araba, I want to buy your oranges. I live in the US, but we'll enter into a forward exchange rate contract so that we would peg the exchange rates at today's date for some agreement that was going to happen at a future date. So that's what we mean by a forward contract, a forward contract. Now there's a technical definition for that, which I can obviously, students like definitions. So, which I can definitely read for you. So it's simply a contract between two parties to buy or sell an asset at a specified price. So you determine the price, right, on a future date. You know, so how is the forward contract applicable? How is it applicable, right? So let's say you're in business, right? I'm in Ghana, I'm doing business in the UK. So what I see is that sometimes we even do it, right? Okay, this is the ICA, right? But let's say if you are taking CIMA, you're taking ACCA, you know that you could project, right? You could project. You could tell that maybe in the coming months, the CD will depreciate, right? So if you have to pay subscription or pay for exam fees, you do it quickly now. Now that's a crude example, but let's say if you, Mr. Menu, who is a Ghanaian businessman, enters into a contract with Lee Kuan Yew in China, you know, for him to send him some products. If he enters into a forward contract, he does so because he looks at the market and sees that, you know, maybe the yuan, the Chinese currency, is going to appreciate. So what does he do? Even though the settlement is supposed to be done on a future date, he enters into a contract with Mr. Yuan now and says that, you know what, I'm going to buy your goods at so and so price now for settlement on a future date, so that even if the Chinese yuan currency appreciates, he is safe. Mr. Menu is safe. I hope that makes sense.
Yes, sir.
Yes, please.
Okay. One of the things I did not mention here was I'm not sure why I did not mention it, was futures. You know, futures contracts. You hear forward contracts, you should also hear futures contracts, right? It also has the same ideology, right? So I would like to explain what it is and what it actually means. So when we say a futures contract, then after that, I'll explain the difference between a forward and a future. A forward and a future. So when we say a futures contract, we simply mean that can you hear me, please?
Yes, sir. Yes, sir.
Loud.
Okay, so when we say a futures contract, it's simply an agreement to either buy or sell an asset on a specific date, sometime in the future. So you are buying or selling an asset on a specific date, sometime in the future. And you are doing it now. You are entering into that contract now. So how does a future? Okay, let me repeat myself again. so that it's quite clear. It's simply an agreement to buy or sell a particular asset at a specific price, right? At a specified time in the future, but you're entering into that contract now, basically. So what is the difference between a future and a forward? A future and a forward. So a future is a customized contract. A future is a customized contract, right? So what do we mean by customized? It's tailored to the needs of the parties. So it's a customized contract, but sorry, a forward is a customized contract. A future or a futures contract is a standardized contract. A forward is a customized contract, so you can customize it to your own needs. A futures is, it's a standardized contract, so it has some standardized terms. Another difference is that the forward is traded over the counter. The futures is traded on an organized exchange. On an organized exchange. So these are the two main differences. They kind of like achieve quite the same purpose. They kind of achieve the same purpose, but these are some differences. Were very, very well-known differences. Yes, so these are some of the ways that you hedge against risks, right? So let's say, let's say you get into a case and you realize that, they're having treasury management issues. That's when you need to sit down and say, okay, should they enter into a forward contract? The interest rates, do they have to swap if they're on variable interest rates? Do they have to swap and go for fixed? Those are the kind of questions that you ask yourself. I hope that makes sense. Okay, I think that makes perfect sense. So, any questions for me? I decided to leave some few minutes so that we can talk about exam. If you don't have any questions for me, even before I share what I have to say? Any questions for me? Wow, so it means that everything made sense. Interesting. That's fantastic. I must be an amazing teacher then. Okay. Okay, so again, since we are heading towards the exam, what I always try to do is I try to give you tips and tricks to help you pass your exam. Let me mention this. For strategic case study, like I've always said, please take time to do some past questions. Take time to go through the slides. Take some time to, refresh your memory with the models. It's very important. I sent some, ACCA materials. I don't know if that will be useful for you, but if it does help, fantastic. If it does help you, that's amazing. But please spend some time, go through the past questions. I've said this over and over again. That's the only way you'll be confident about what you're doing. So please spend some time and go through it. And then Yeah, and then you should definitely be fine. You know, I strongly believe you should be fine. Okay, so yeah. Any questions for me? If you don't have any questions, this is where we'll bring this lecture today to an end. We are right on track. We are right on track. God willing, next week, Mr. Seth said, we are right on track to finish this. So next week we'll be going through some models, just seeing how things shape up. That's it. So do you have any questions for me?
No, sir.
Okay. If there are no questions for me, then thank you very much for joining, and have an amazing week.
Thank you so much also.
Okay.
Thank you, sir.
Okay, I wish you all the best too.
Thank you, sir.
Just follow the approach I've been given. At this point, what you should be doing is you need to be learning from questions to what's in the textbook rather than learning the textbooks to questions. So familiarize yourself with questions. So do past questions. Then you chip in the slide little by little, do past questions, you know, familiarize yourself with the concepts, or build your confidence, because you want to spend 80% of your time doing what you would go and meet in the exam. You know, going through that big book, the strategic case study book, you might learn all of that and go into the exam and everything will just be off. So just take the past questions, read them. If you don't understand them, read. You do it over and over. As you are doing it, you see that, oh, this thing, when they say this, it means this. When they say this, it means this. And, you know, yeah. And just familiarize yourself with the models, and that's it. So thank you for joining. Have a good weekend. And for those who are doing audits, see you, God willing, tomorrow. Bye.
Thank you too.
Thank you.
Bye.
Bye.
Bye.